Hi everyone, thank you for attending our webinar. We'll get started momentarily. Hi everyone, I'm Amanda Gerber, Marketing Director with DWD CPAs and Advisors. I wanted to thank you for registering to attend our webinar today. I know it has been a challenge for us navigating through these unusual times, so I hope you find the information in today's webinar useful. Before we get started, I wanted to cover a few housekeeping items. Please use the Q&A feature at the bottom. We will be addressing all submitted questions at the end of this presentation. Also, a link to the webinar recording along with the slides will be emailed to you later today. With us today is Zach Richards, CPA and Certified Fraud Examiner. Zach is a director here at DWD and has been a CPA for over 12 years. He primarily works with business owners, providing assurance and tax services. For the last 5 months, Zach has become our expert at DWD as we navigate through this pandemic and the PPP loan process together. At this time, I will turn it over to Zach.
All right, thanks Amanda, and good afternoon everyone. Looks like most everyone has joined now, so we'll go ahead and get started. Welcome to today's webinar, Paycheck Protection Program, Where Are We 2.0. I want to address two things as we get started, just to kind of set some parameters as we go through this. One, I want to guarantee you that I don't have all the answers yet, and we still need additional information from the SBA. But hopefully, with some of the recent guidance we do have, you'll find today's presentation to be useful. And the second caveat is that the materials in this presentation are as of 1 p.m. on August 20th. The rate at which guidance and changes have been coming from SBA and Treasury, it's quite possible we'll finish this webinar and there'll be some new piece of information out. So where are we? I did my first PPP webinar back in May, and at that time we focused primarily on the loan application and receiving the funds. And at that time, I came up with this slide to say, in May, I think we were somewhere between lost and very lost, and probably didn't have a very good idea which direction we were heading. So for today's webinar, I had to come up with an idea where we are as of August 20th. And this is what I came up with. It just kind of feels like the year is stuck in April. It's hard to believe that it's August already. And ever since this pandemic started, it just seems like things are kind of dragging along. We're out of our normal routine and normal schedules. But that's kind of where I think we are at this point in time. And I think the main reason why we probably feel lost and not really sure where we're at is there has been so much information and so much guidance issued by the SBA, which is a good thing. But at the same time, it hasn't really been, in my opinion, a great centralized location to be able to get the information. And so this screenshot here is actually from the SBA's website. And if you go to their website, you can see the different interim final rulings that they've published. And to date, we've got 24 separate documents of guidance that SBA has issued. And in some cases, there will be a new interim final rule that contradicts a previous interim final rule. And so to be able to work your way through these 24 documents and make sense of it all can be very confusing for everyone, both the borrower and the lenders. So here's an agenda for the discussion we'll have today. I want to talk about some of the loan forgiveness applications that are currently out there. We'll do a quick overview of just how the general loan forgiveness process is supposed to take place. We've got some SBA FAQs that were issued in the last couple of weeks. That was geared specifically towards loan forgiveness. So I want to go through those in some detail, and then finished up with some pending legislation in the HEALS Act and some other legislation that may relate to your Paycheck Protection Program loan in the Families First Coronavirus Response Act. So let's talk briefly about the applications that can be used for loan forgiveness. Right now we have two different applications, and after this presentation, I'll email everyone a copy of these slides so you can follow these links, which will take you directly to the applications and the instructions. But basically at this point, we've got the main forgiveness application, and that consists of the form as well as a Schedule A and a Schedule A worksheet. And a lot of it just feeds off of each other. Then they came out with this easy form and said, well, if you meet certain criteria, you don't have to do Schedule A and you don't have to do the Schedule A worksheet. And we think there will be a handful of people that will qualify for the easy form and hopefully make the process that much smoother for them. We'll talk a little bit later too. There's some pending legislation in the HEALS Act that could create 2 more loan forgiveness applications, and see how that might impact us. We've been getting a lot of questions on the easy form and who might qualify for it. You'll see if you go to the easy instructions, there's this box here with the 3 different check boxes. And to qualify for the easy application, you have to meet one of those 3 check boxes. My guess is that for people that do fall into it, they'll probably meet checkbox number 2. And there you're saying you didn't reduce your annual salary or hourly wages by more than 25%, and you didn't reduce the number of employees or the average paid hours. So if you didn't have a reduction in work, everyone works the normal hours and you have the same number of employees or more, then you're probably going to meet the requirements here in number 2 and be able to fill out the easy form and save yourself some headache and some of the calculations. The other one that comes to mind is checkbox 3. There you still have to meet where you didn't reduce your salary or hourly wages by more than 25%. But you could have a reduction in employees or average paid hours if you were unable to operate at the same level of business that you previously were operating at due to some of the restrictions that CDC and Health and Human Services put in place. And the one I think primarily there are the restaurants. So if I was a restaurant owner and I was forced to shut down, the government wouldn't allow me to be open, then would I still be able to meet the requirements of the first part of checkbox 3 and possibly qualify for the easy form? So hopefully there'll be a decent amount of folks that can meet these requirements and make the process that much easier. And we'll just have to see how it plays out. Real quickly, I want to go over just some of the basic parameters of how the loan forgiveness is supposed to work. And the loan forgiveness itself has changed a lot as the program has morphed. In the beginning, when we were on the 8-week period and 75% of my costs had to be for payroll costs, and at that time, there were a lot of businesses that weren't operating at their full capacity. We had a lot of borrowers that were trying to maximize their loan forgiveness. They knew they only had 8 weeks, and they knew they needed to get their payroll costs up. So At that point in time, the thought was, how do I maximize my loan forgiveness? Now we've transitioned to this new 24-week period. I've only got 60% of my costs that have to be used for payroll. And so we're moving into a new phase to say, I know I'm going to get fully forgiven. I've got 24 weeks. That's not a problem. But how do I make this application for forgiveness go as smoothly as possible? And I'm not doing any more calculations than I have to. So the loans can be fully forgiven. They do have to be used for payroll, interest on your mortgage, rent, and utilities. Under the new rules, at least 60% of it has to be for payroll. And you do have to maintain your employees at a certain level. So if you had a reduced number of employees, there are calculations that'll play into determining how much of your loan can be forgiven. They'd also have an alternative payroll covered period. If you haven't considered that yet, you may want to look further into that. Essentially, if you pay your payroll on a weekly or biweekly basis, you qualify for the alternative payroll covered period. And what it does is it allows you to move the start date of your covered period to coincide with the beginning of your next payroll period. And that'll help you when you're determining your payroll costs. You'll have full payroll periods in calculating the cost. Otherwise, if you're on the regular covered period, you're going to have to prorate the beginning of your covered period for however many days on that payroll and possibly at the end. The other thing to keep in mind, this last one, if you had employees that you tried to bring back and they refused that offer, those don't hurt you as far as the calculation of maintaining your FTEs. There are some requirements in there. It has to be a good faith written offer, and you've got to have some way to show that the employee declined that offer. But if you've got people that aren't coming back to work when you are ready for them to come back to work, that doesn't necessarily have to hinder your FTE calculation. So now the bulk of the presentation, we'll move through some of these frequently asked questions that the SBA published. It's the first time that they've given us guidance specifically on loan forgiveness. They came out with a FAQ document early on regarding the loan application process. And as questions arose, they would update that document. So hopefully here with the loan forgiveness, they'll continue to update this and answer questions that they're seeing come through on a recurring basis. But they did a pretty good job in this first batch of addressing some of the major issues. We still don't have answers on everything, but let's take a look. And the first one here is regarding the 8-week period or the 24-week covered period. And can I pick somewhere in between if I don't need it for a full 24 weeks? And technically, you have to elect 8 weeks or 24 weeks. So if you find yourself that after 8 weeks, we don't quite have enough cost to maximize loan forgiveness, or we think we could maximize loan forgiveness after 8 weeks, but it would be a pain to do all the calculations that would require it, and we could just do 24 weeks, and it might be easier to do payroll only and not worry about the rent and the utilities, then you need to elect the 24 weeks. But what we'll see on the next slide here is, what if I don't need the full 24 weeks? Is there anything I can do to apply for forgiveness before that? They've come out and said, yes, you can. There are a couple of things to keep in mind. If you apply early, technically your covered period is still the 24 weeks. So if you do have reduced salaries or hourly wages in excess of 25%, that reduction is going to be over the entire 24-week period. And so you would have to do a calculation to basically take that reduction over the entire period. So even if you are meeting full forgiveness after 14 or 16 weeks, this reduction could impact you over the 24-week period. The other thing I'll say here is, with everything that's going on right now, until we have more answers on some of the outstanding questions, I wouldn't recommend being the first one to apply for forgiveness unless you have some extenuating circumstances as to why you want to get it forgiven sooner than later. I know a lot of us just want to get this done and put behind us, but it may make more sense to just have some patience, wait this out, and kind of see where things end up once we get a little bit further on in the year. And that'll bring me into the next slide, which is probably one of the biggest outstanding issues we've got now, and would provide a great reason why you may want to be patient in applying for loan forgiveness. And the question is, are the expenses that I use for loan forgiveness tax deductible? The IRS came out with a notice, 2020-32, at the end of April, and they said that no deduction is allowed that is otherwise deductible if the payment of those expenses results in loan forgiveness. So essentially, you can't get your loan forgiven for certain expenses and also get to deduct those expenses on your tax return. It was a little confusing because the CARE Act specifically said that if you've got canceled debt, that's going to be excluded from gross income. And so on one hand, it's not includable in gross income, but then the IRS is saying, well, it's also not, you can't use those expenses. So there were some key figures that chimed in on this issue. Secretary Mnuchin sided with the IRS, saying it was basically tax 101. And then we've got Senator Grassley and some of the key members of Congress sending a letter to Secretary Mnuchin saying that's not what we meant. That wasn't our intent when we passed this bill. And so we're going to have to see how this plays out. If it doesn't get fixed and if things stay the way they are, it could bring up some scenarios where we have to decide when and how much of these expenses that aren't deductible are going to need to go into our tax return. And where it can get primarily difficult is if I've got a tax return that I'm doing a December year end. By the end of December 2020, I've essentially used up my entire 24-week period, and I've probably expended more than enough funds to get full forgiveness. It's also highly likely that I haven't gotten my loan forgiven by the end of 2020. As you may recall, now that we've got 24 weeks, if I got my loan in April, that probably pushes me out to October. And then once the 24-week period is up, I have 10 months before I have to apply for loan forgiveness. And then even once I apply for loan forgiveness, the bank and the SBA have an additional 5 months to process the loan forgiveness. So we could get into a position where I need to file my 2020 tax return, and I need to determine whether those expenses are deductible or aren't deductible. The way the law reads, and a lot of people are interpreting it, is that those probably aren't deductible in 2020. But if the loan isn't forgiven until 2021, it creates some headaches there in determining what you should do, particularly if you're not going to get full loan forgiveness. Luckily, I think just about everyone is going to get full loan forgiveness. But imagine if you were going to only get 80% of your loan forgiven, and then you had to determine how much of the 80% relates to 2020 and when to recognize it on your tax return. So I'm hopeful that Congress and the IRS can, even if it stays the way it is, at least get to a point where we know that's the final answer. And right now, I don't think we're at the final answer yet. When the Paycheck Protection Program came out, we also had a lot of borrowers looking into the Economic Injury Disaster Loan, the EIDL program. And there were some ways that you could get an EIDL and have some of that, up to $10,000, forgiven. The one thing to keep in mind, if you did find yourself in getting a loan through both programs, the portion of the EIDL that acts as a grant, which could be up to the $10,000, that will offset any PPP loan forgiveness. So you can't max out your loan forgiveness and also get this $10,000. the $10,000 would be reduced off your PPP loan forgiveness. Another popular question, and I think it's going to take some planning here, is how do I account for the forgivable loan under the PPP? And so I've got a link here to some guidance that the AICPA put out. And essentially, I think most people understand how we're going to initially record it. We've got the cash inflow that we're going to receive from the loan, and we're going to have an offsetting liability as it's essentially a note payable at this point. But at some point, that note payable is going to be forgiven. We have to recognize that somehow. And the way to do that is to reduce the note payable, and the offset will go through the income statement. It brings up a question of, well, how and when do I recognize that income? Do I have to wait until the SBA formally forgives it, and that's when I can recognize all of that income? If that's the approach that we take, then that's probably going to be in 2021. If we come to the conclusion that I should record the income as I incur the expenses that will be forgiven, then I've got an issue where I'm going to recognize the income potentially in 2020, even though it's not formally forgiven until 2021. And so putting this piece of it as far as how to recognize the income and expenses on the books, and how we previously talked about how the tax return can be impacted, I think there's a lot of planning that's going to need to go into this just to make sure there's no surprises when we get to year end. If a borrower submits a timely loan forgiveness application, when do we have to start making payments? And the SBA has come out and said that you're not going to be required to make any payments until the forgiveness amount is remitted from SBA. So if you've got a situation where technically you've waited up to 10 months and then you finally get an answer back from SBA, you don't have to worry about making those payments until you actually know how much is going to be unforgiven. It's important to keep in mind that the interest accrues from the beginning of the loan, but that only accrues on the unforgiven portion. So if you think you might not get it all forgiven, you may want to not wait the full 10 months, just so you're not accruing interest on that unforgiven portion. Our payroll costs that were incurred during the covered period or the alternative period, but were paid outside of that, are they eligible for loan forgiveness? There'll be a handful of slides that we'll go through here that will have similar language to this. And the key phrase to keep in mind here is that these costs have to be either paid or incurred during the period. So with payroll costs, it's possible that you're going to pay payroll costs that were incurred prior to the covered period. Those would be eligible. It's also possible that you're going to incur payroll costs during the covered period, but not pay them until after the covered period. And so it's beneficial to the borrower. It allows you to include more expenses than strictly the 8 weeks or strictly the 24 weeks. So it is helpful, but it's kind of confusing at first to wrap your head around. Same thing here where we're looking at the timing of when they were incurred. Our borrower is required to calculate payroll costs for partial pay periods. We talked about this a little bit ago with the alternative payroll covered period. There's some additional guidance here, but essentially, if you're weekly or biweekly, if you can meet the alternative requirement, I think most people are going to want to elect this. It's going to make it a lot easier so that you don't have to prorate multiple payroll periods at the beginning and end of your covered period. For purposes of calculating cash compensation, should I use the gross amount or take into account any deductions or similar payments? And when we're looking at cash compensation, we want to strictly look at the gross wages. are only salaries and wages covered by loan forgiveness, or can I pay lost tips, commissions, and bonuses? Here, all forms of cash compensation that's paid to the employee is going to be eligible. So if you've got tips, commissions, bonuses, hazard pay, overtime, anything like that, as long as it's cash compensation, that's going to count towards your payroll costs. However, keep in mind that each employee is limited to that $100,000 annualized amount. So before you go and pay a big bonus just to try and maximize loan forgiveness, keep in mind that employee by employee is going to be limited to that $100,000 annualized basis. What expenses for the group healthcare benefits are considered? Essentially, employer expenses for your group healthcare, those are going to be allowed. If it's paid by the employee, then it's not going to be allowed. And I think that should be pretty straightforward for most individuals. Contributions for retirement benefits. Again, if it's paid by the employer for employee retirement benefits, those are going to be eligible. Any employee portion would not be. They did come out and say this last bullet point here. There had been some question of, well, can I beef up my contributions to the retirement plan during my covered period? And they're essentially saying no. If you're accelerating payments from periods outside of your covered period, those aren't going to be eligible. This next one is another big topic as it relates to owner compensation. When the program first came out, there were a lot of questions as to a term that SBA used, with being the owner employee, and what was an owner employee, and how are they different than other regular employees. And so we do have some good examples now that hopefully will help people get familiar with how the owner compensation is calculated. Before we get into it though, one recommendation I would ask you to consider is, if you can maximize your loan forgiveness without including any compensation to owners, my personal opinion, it would be that this could get really dicey in how you're going to calculate owner compensation. And if you don't need it, don't make your life harder than it needs to be. Especially if you're in a position where, well, we think we can get maximum loan forgiveness after 14 weeks, but if I just wait till 18 weeks, then I don't have to do all these owner calculations, and maybe I don't have to worry about the utilities or the interest, and I can just stick to employee only payroll. I think as long as you're maximizing loan forgiveness, then now we want to kind of move to a strategy of what makes my life easiest, and we'll have fewer questions from the lender and fewer questions from SBA. That being said, though, we do have the owner compensation that we can look into. There are a handful of different limitations that'll be in place, so we'll go through that. The main thing to keep in mind here is, if you're on an 8-week period, that cap's going to be the $15,385, and that's the $100,000 annualized over 8 weeks. When they switched to the 24-week period, we assumed that, well, if I got the $100,000 limitation over 8 weeks, I would get the same amount over the 24 weeks. And as we'll see on this next slide, that wasn't really the case. For whatever reason, they said that for non-owner employees, they can still do the $100,000 annualized. So if I'm 8 weeks, I'm at the $15,385, and if I'm at 24 weeks, I essentially get 3 times that amount at the $46,000. But if I am an owner employee, I'm still at the $15,385 over the 8 weeks, but I only get $28,33 over 24 weeks. And the $28,33 is $100,000 divided by 12 and multiplied by 2.5 months. So I think the thought process here by SBA was, when you received your loan, it was based on 2.5 months of your payroll costs in 2019. We don't want to give you more than that for loan forgiveness on your owner employees. If you're going to go above that for some of the non-owner employees, that's okay, but we don't want the extra money going to the owner employees. And then I've got a table here that talks about, depending on the type of entity you are, whether health insurance, retirement, and state and local taxes are eligible. I don't know how they came to the conclusion based on certain entities of how they're going to do it. I think they made it a little more complicated than it probably needed to be. And that's why I get back to the whole thought process of, if I don't have to go through these to maximize loan forgiveness, then maybe it's not worth it. If you do, though, this table here will help you work through that. The FAQs that came out, I thought this was one of the best things they did, and they gave specific scenario for owner employees by entity type. So if you're a C Corp, you can come here and see specifically how we're going to be limited and what things are going to be limited or not eligible. So we've got one here for C Corp, nothing too crazy here. Again, the loan forgiveness is up to the 2.5/12 of their 2019 employee compensation, and so we've already got the limitation of the $20,833 over the 24 weeks, and now another limitation that we're going to have is 2.5/12 of 2019 compensation. So it should work out where we're still able to maximize loan forgiveness, but it's just one more calculation we've got to put in there. The other one that's interesting here too is the retirement contributions for the C corporation owners. Those are limited to 2.5/12 of their 2019 employer retirement contribution. So they don't want you beefing up a lot of expenses for your owner employees more than you would have had in the prior year. One thing that's interesting, and we'll see this kind of on a handful of these slides, is the payments for these other than cash compensation. There's a line on the application itself that's specifically for owners, and then these lines 6 through 8 are where the insurance and retirement and whatnot are included. And it's going to get confusing because you're going to have some costs that technically are owner compensation costs. They're not cash compensation, and they're going to go in that 6 through 8. And I just feel like you may be getting a lot of questions from lenders as to, okay, you put a certain amount of health insurance on this line. How much of it relates to owners? How much of it relates to non-owners? So just keep in mind as you're working through the forgiveness application to make sure you have it all broken out so that the lender can easily see what costs belong to which types of employees. S corporations, not a whole lot different here. The one thing that we didn't really know much more about before, but was this, were there certain S Corp owners that weren't really owner employees? And we've got something here on including any employees that have at least a 2% stake in the business. Those contributions for health insurance, those are already included in their cash compensation, and so those don't get affected here for the S Corp owners. And then if we've got any self-employed individuals, essentially we're looking off of the 2019 net profit and calculating that. So not a big change there from what we expected. And then general partners. The last one, LLC owners, basically, I found this was interesting, that if I've got a new business as an LLC, I get to pick whatever my expected tax filing situation for 2020 is going to be. And I get to apply based on that for loan forgiveness. So those were a lot of the payroll related costs. Now we'll move into some of the non-payroll costs. Here, similar question as earlier, what about non-payroll costs incurred before the covered period but paid during? Yes, those are again going to be eligible as long as they are paid or incurred during your covered period. Same thing here if they're incurred during but paid after. The main thing here, if you do pay them outside of the covered period, you have to pay it on or before the next regular billing date. So if it's due on November 6th and the end of your covered period is October 24th, if you don't pay that by November 6th, then it's not going to be allowed. If a borrower elects to use the alternative payroll covered period, does that mean I'm also using the alternative period for non-payroll costs? And the answer there is no. That is the one thing that can get a little tricky with the alternative, is it's payroll only. So you essentially have two different periods that you're looking at. You've got the alternative period for anything that falls under the payroll category, and then the items outside of that for the interest, the rent, and utilities, you're still going to have to use the regular covered period. Your covered period starts on the day when you received your disbursement from the lender. Interest on unsecured credit, is that eligible for loan forgiveness? And the answer here is most likely no. The payments of interest on business mortgages, it has to be on real or personal property. So there has to be, it's got to be securing some type of property. And so if you've got a line of credit that's just funding your operations, then that's not going to be eligible for loan forgiveness. It's interesting though that interest on unsecured credit, it is still an allowable use of the PPP loan. It's just not eligible for loan forgiveness. Are payments made on renewed leases or interest payments on refinance mortgage eligible? And they have come out and said yes. So as long as the original agreement was in place before February 15th, if it's subsequently modified, those payments are still going to be eligible. The main thing is that something wasn't originally in place prior to February 15th. Will a borrower be subject to a reduction amount in forgiveness if we have a reduction in FTE employees, but we offered to rehire laid off employees and they declined? And we talked about this briefly before. You can exclude any reduction in your FTE employees as long as you can show that in good faith that you had an inability to rehire individuals that were employees as of February 15th, 2020, or if they didn't come back and you weren't able to hire similarly qualified individuals, then those don't hurt against you. And that could be a little difficult to be able to specifically show that. The one I think of is if I'm a restaurant and I've got 10 waiters on staff and one of them leaves, or let's say 3 of them leave. When I hire someone back, did I replace a certain one of those 3 positions, or which one was it, and whose hours get replaced? You're going to have to use your best judgment in those cases, but hopefully it won't be a big impact on your calculations. Another interesting thing is they came out and SBA said if you do offer to rehire a laid off employee and they don't come back, you're required as the borrower to inform the state unemployment office that this person rejected an offer of employment. And I think that stems from when we had the $600 federal unemployment assistance. There were certain individuals that could make more money on unemployment and had no incentive to come back to work. And so with this new guidance, they're basically saying it's on you as the borrower to let us know that so we can stop those unemployment payments to that employee. And it puts the borrower in a difficult situation because they're trying to maintain goodwill with their employees and they don't want to lose their employees. They're just trying to get them to come back to work. And you could imagine if you had an employee that didn't come back to work and then found out, well, you called unemployment office and stopped that, that's not going to create much goodwill with your staff. Main thing here is if you do have these situations, do your best to have a documentation of it, a written offer, if you can, a written record that the employee rejected it, and then any documentation you might have of where you tried to hire other qualified individuals or were unable to do so. When calculating the reduction exceptions, do borrowers include employees who made more than $100,000, which are the ones that fall in Table 2? This, the answer here just doesn't make much sense to me, because you'll notice when we get to breaking out the employees, they've created Table 1 and Table 2. And Table 1 is the employees under the $100,000, and Table 2 is over. But the FTE reduction exception is only in Table 1. And so they're saying here that you should include any of those reductions, even if they're from Table 2, include them up in Table 1. And if that doesn't create some confusion, I'll be shocked, because you're going to have FTE reduction exceptions of a certain number. And then my guess is the lender's going to go, well, who are those people? Are they Table 1? Are they Table 2? And how do I know? And so I think the biggest thing here is, as you're putting the application together for forgiveness, you're probably going to have a lot of spreadsheets that go with the application to help explain where you calculated your numbers from. How do borrowers calculate the reduction in their loan forgiveness amount arising from reductions in employee salary or hourly wage? So a big thing here is did I reduce my hourly wage or my salary by more than 25%? And if I did that, then yes, you are potentially going to have some issues there. If you think this is something that's going to create reduction in loan forgiveness for you, I would steer you to going to the original FAQs from SBA. They've put a lot of detailed examples out there surrounding this matter. And I think if you look through those, we won't have time to go through those today, but if you look through those, hopefully that'll provide the guidance that you're looking for. This next one, it could have an impact on a handful of different borrowers, and I'm not sure if it's helpful or not, but the question is that when I'm looking at calculating the loan forgiveness reduction for wages reduced by more than 25%, are all forms of compensation included, or am I only looking at their salary or hourly wage? And SBA is saying now that you only take into account decreases in salaries and wages. And so you'll see a calculation where you're going to look at what were my wages in the first quarter and what were my wages during my covered period. And a question that we had from a handful of borrowers was, I may have very high gross wages in the first quarter because we do a year-end bonus every year and we pay it out in the middle of January, and that makes up 20% of each employee's income for the year. So their quarter one wages are going to be way higher than their wages during this covered period. And so this is some good guidance to let us know that you don't have to include the bonus in calculating this 25% reduction. The other area, though, where I think it could hurt us is if I did reduce employee wages during my covered period, and during the covered period, I realized that I needed to get them up. It's possible that a borrower would have paid a substantial bonus during the covered period in order to get those wages back up. And here it doesn't specifically say that they could or couldn't be included, but my guess is that if bonuses aren't included for quarter one, then they're probably not going to be included for the covered period. And so I don't think that'll affect too many people, but it could be a case where it works against one or two. So those are the main FAQs from SBA at this point in time. I'm hopeful that they'll continue to publish additional questions and give us more guidance as we move through this process. Now I want to move on to some of the legislation particularly pending legislation that could have an impact on how the PPP is going to work going forward. And so right now we've got the HEALS Act, which is essentially in response to the HEROES Act. The HEROES Act was passed by House Democrats earlier in the year, but nothing was ever really done with it in the Senate. And so Senate Republicans came out with the HEALS Act at the end of July. It's a $1 trillion stimulus package. There's a lot of different pieces to it, but within it is this Continuing Small Business Recovery and Paycheck Protection Program Act that I want to take a look at because it specifically relates to today's discussion. And if the HEALS Act would get passed, we would be looking at a couple of new things with the program. One, it would expand allowable and forgivable expenses, which is fine, but once we moved from the 8-week period to the 24-week period, I don't see this being as big of an impact or as critical to most people, because the 24-week should be enough to maximize loan forgiveness. But for whatever reason, if you're going to have a lot of reductions in your FTEs or salary and hourly wage, or you just don't feel like you're going to be able to maximize loan forgiveness, there are some new expenses that they're talking about making eligible. The big one here are these next two bullet points where they're looking to create a simplified application, one for loans that are under $150,000 and one for loans that are between $150,000 and $2 million. So if you're under $150,000, you don't have to submit any documentation to the lender. You just have to attest to a good faith effort. And the large portion of loans that were issued under this program are going to be under $150,000. So if this gets passed, that could be a big deal for a lot of borrowers. And secondly, then between 150 and 2 million, you're not required to submit documentation to the lender, but you have to complete a certification. And again, if you're looking at all lenders, or excuse me, all borrowers 2 million and under, that's gonna have a huge impact on the forgiveness process. The one thing that I'm not sure about with these applications is, does this help or hurt the lenders? I know we've got a handful of lenders attending today, and as each loan forgiveness application comes out, the lenders have to have a new process for what's going to be required with this application, what's going to be allowed as evidence or supporting documentation. And so I would be curious to know, we could potentially be up to 4 loan forgiveness applications where do I want to do one of these two depending on the dollar amount, or do I want to do the easy form because I meet that certification, or for whatever reason do I want to do the full application because I want to provide everything initially so there's no questions down the road. I mean, there could just be a lot going on here, and I feel like the lenders are now just going to have 4 different ways that they're going to have to process these loan forgiveness applications. So hopefully that's not going to be a big hindrance and hold up their end of the process here. And lastly, it creates essentially a second round of funding for certain eligible businesses to get more PPP funds. They would have to be a business with 300 or fewer employees, and you'd have to show at least a 50% reduction in your gross receipts as you look at first quarter or second quarter 2020 and compare it back to 2019. So you'd have to be pretty heavily impacted in order to qualify for this second round of funding, but it would provide some additional for those that have been hurt the most. So with the HEALS Act, just keep an eye on that. I'm hopeful that Congress will get something done fairly soon, but I think we all know how that can go sometimes. The last thing I want to talk about is the Families First Coronavirus Response Act, the FFCRA. And so as we move through this pandemic and we get later into the second half of 2020, my gut feeling is that most businesses are pretty familiar with the Paycheck Protection Program. maybe we're not as far along in the forgiveness process, but we know the general stipulations within the PPP. And I think as we move further into the year, the FFCRA is something that we're going to want to be more and more aware of. And I think part of that is because we're back to school starting, and we already are hearing multiple school districts showing that we've got COVID cases, kids are being sent home and being required to quarantine for 2 weeks. And I think one of a couple things could happen. One, your kid could get COVID and be sent home, or they were in a class with a kid that has it, or on the school bus with a kid, and they, just by doing the contact tracing, they're going to have to quarantine. And as more and more kids are going to be required to go home, that could be create a need for employees to be taking leave under the FFCRA. And so it's good to know what your requirements are as an employer, what your rights are as an employee, and the available tax credits to be able to help make all of this work. So when they passed the FFCRA, they essentially said that starting on April 1st, if you've got fewer than 500 employees, you have to provide paid sick and family leave if certain conditions are met. However, when you pay these employees for taking this time off, you're going to get reimbursed through your payroll taxes, either partially or as a full reimbursement. And there's a couple different ways to do it, either as you remit funds for your periodic payroll taxes or when you do your quarterly returns. There is this last bullet point. If you're a small business with less than 50 employees, it is possible that you can claim an exemption, saying that of the different buckets that you can fall into for the paid sick and family leave, one of them is if my child can't go to school or can't go to childcare. If you've got less than 50, it's possible to get an exemption from that part of it for the expanded FMLA. The key here, though, is that you've got to be able to show that it would jeopardize the viability of the business. So if you've got 49 employees, but business is good and you're making money, that's going to be hard for you to qualify for this exemption. So I want to walk through this table. It tries to break down the 3 different buckets of how employees might take leave under the FFCRA. And the first 2 buckets are under the Emergency Paid Sick Leave Act. And then the last one is the Emergency FMLA expansion. So if we look at the Paid Sick Leave Act, this is essentially to pay employees for up to 2 weeks. And you've got the 2 buckets here. In the first bucket, items 1, 2, and 3, if the employee is subject to quarantine or been advised that they should self-quarantine, or lastly, if they're experiencing symptoms and seeking a medical diagnosis. If you've got an employee that falls into one of these 3 buckets, then technically they can take up to 2 weeks off. And there is a limitation here of $511 per day. And after you pay them, then you get that as a 100% refundable tax credit. Then we move over to the second bucket of the Paid Sick Leave Act. And 4, 5, and 6 are essentially, if any of the requirements of 1, 2, and 3, except if it's for caring for someone that has it. So the employee doesn't necessarily have any issues, but they're caring for someone that meets those requirements. Alternatively, if you've got a child that can't go to school or their child care has been closed, that would qualify. And then the last one is just kind of a, not sure when you would ever use this, but they threw it in here anyway. So if you've got anything specified by the Health and Human Services in consultation with Treasury and Secretary of Labor, that qualify. And that one has a smaller limitation of just $200 per day. And you're also limited on the refundable tax credit. So you're limited to 2/3 of the employee's regular pay. And so if you've got employees that are taking leave under these, you essentially have a choice. You can pay them 2/3 of their regular pay, and you're going to get the full tax credit. Or you can pay them their full regular pay, just as a token of goodwill, if you will. But you would be limited to their tax credit only being for 2/3 of their pay. And so those are the first 2 weeks that you would be eligible for something. And if it goes beyond the 2 weeks, then you move into this expanded FMLA, where this is strictly if you have an employee that's caring for a child where the school is closed or the child care provider is unavailable. There's a couple things within this to be aware of. One is the employee has to be unable to work or telework. So, nowadays there are a handful of businesses where the employee can do just about everything from home through their laptop connected to their works network. If they've got that capability, they can't claim this issue. The other thing that I don't know an answer on and would be interesting to see is it says that the school has to be closed. What if my child is at a school where they're offering virtual learning or in-person learning, and out of an abundance of caution, I keep that child home and have them do virtual learning? Technically, the school isn't closed. So would I qualify for this expanded FMLA? And I'm not sure how that would play out. But if you do have a situation where this is happening, again, it's 2/3 of the regular pay for the employee at the $200 per day max. You do have to wait 2 weeks before you can take the expanded FMLA. However, you can use it in conjunction with the Paid Sick Leave Act. So if an employee has a child that's home, they could use item number 5 under the Paid Sick Leave Act for 2 weeks, and then immediately roll in to the expanded FMLA for the subsequent 10 weeks. So there's a lot there. We've had a handful of businesses that have done their second quarter payroll tax returns and had to work through these calculations, and they're not a lot of fun, but just know that these tax credits are available. And the reason why I think it's pertinent to the Paycheck Protection Program is early on when the Paycheck Protection Program started and we had only 8 weeks to maximize loan forgiveness, a strategy that a lot of borrowers had was, even if I've got employees that qualify for FFCRA, I can't use wages for PPP loan forgiveness and also get this tax credit under FFCRA. I have to pick one or the other. And so a lot of borrowers were saying, I'm just going to focus all of these costs, I'll just throw them into Paycheck Protection Program so I don't have to mess around with these tax credits. Now, as we move into the 24-week covered period, I'm already going to maximize my loan forgiveness without these wages. So am I better off to make sure that if I'm eligible for FFCRA wages, that I'm taking the proper payroll tax credits? So just keep that in mind and know that's out there and may have an impact on how we work through the rest of 2020. That's all I've got today. If you have any questions, feel free to give me a call or email me. I'm happy to assist any way that I can. Connect with me on LinkedIn. I try to post any updates that I get from SBA out there for the latest guidance. And I thank you for your time today. If there's any questions, let me see what we've got here. I can answer a couple. If you need to jump off, that's perfectly fine, but I'll see if I can do a couple of questions. One question here is, has SBA given a date that the forgiveness application must be filed by? The application form gives an October date. Is this date correct? So the way that the application for forgiveness is going to work, whatever the last day is of your covered period, at the end of that 24 weeks, you have 10 months before you have to submit your application for forgiveness. If you do not submit it within that 10 months, they're just going to treat the loan as a loan. Nothing is forgiven, and your payments are going to start at that time. But outside of that, you just got that 10-month window to make sure you get it in. Let me see what else we've got here. we reduced pay for 3 weeks total over a 6-week period. Then we went back to full pay. Is there a red flag in that at all? I don't think so. At the end of the day, the nice thing about the 24 weeks, you're going to have, most likely, you're going to have so much payroll cost that even if you do have a reduction in FTEs or a reduction in wages, it's not going to be enough to get below maximum forgiveness. So I really don't think that's going to be an issue. It may require you to go, an additional 2 weeks of payroll. So instead of applying after 14 weeks, you might have to wait 16 or 18 weeks. But I don't see that having a big impact there. When calculating FTE, there is nowhere on the forgiveness application to do the FTE for owner employees. How should we compare prior period FTE to current FTE? Do we exclude them from both periods? Yes. So I don't believe your owner employees are going to count into your FTE calculation. Regarding the requirement to submit a notice to the state unemployment office, if the employee did not return to work and they did not file for unemployment benefits, will an email from the employee that he or she is not going to return to work suffice for documentation? I would say yes. At least you've got something that says that they're electing not to come back to work. I think that would be fine. We've got a question here. What if a school isn't closed but is remote? So we kind of talked about that a little bit. I don't know the answer on that for sure, but that would definitely be something that we would have to make a determination on before I would feel confident in moving forward with it. Does an employee have to work for at least 30 days with the employer to be eligible for sick pay? I assume this means that the sick pay under the FFCRA. I don't recall seeing that as a requirement. It could be in a fine print, but to my knowledge, I don't recall seeing that. If the business chooses the 8-week period instead of the 24-week, does the 10-month filing period begin at the end of the 8-week period? Yes. So you've got the 10-month period either way, is my understanding. Gasoline expense for company-owned vehicles, are those considered an eligible transportation utility expense? We've gotten this question a lot, and we don't have a great answer on it. There is some language in one of the interim final rulings that says fuel costs for a self-employed individual would be considered a transportation utility expense. So I think the consensus is if fuel costs for a self-employed individual that has a business vehicle count, then certainly that should count for other borrowers as well. They haven't come out and just laid it easy for us to see it like that, but I think most people are interpreting it that way. And then the last question we've got here, if we don't maximize our PPP over the 8-week period, do we do the 24-week? And I think that's going to be a resounding yes. If you're not maximizing loan forgiveness, there should be a really, really good reason why you're not. So make sure if you need the 24 weeks, take the 24 weeks. And even if you get to the 24 weeks and you're not maximizing loan forgiveness, check and recheck your calculations, because I think Congress is really trying to push for everyone to get this forgiven when all is said and done. And I would hate to see anyone not get the maximum forgiveness. So if you run into that issue, feel free to reach out to me and we can work through some questions that you might have to make sure we're capturing all our eligible expenses. So that's all the questions that I see coming through. Again, thanks for everyone's time today, and wish you and yours the best as we move through the rest of 2020.